Welcome to the Outlier Mindset Podcast, your guide for living a life by design. Here, we explore the journey of becoming an outlier, finding your purpose, mastering your mindset, optimizing your health, achieving financial freedom, and building a life centered around your passions. So tune in, transform, and thrive. Welcome to the Outlier Mindset. Let the journey begin. Hey, everybody. Welcome to the Outlier Mindset Podcast. I'm your host, Rodman Schley, and today we welcome one of the top legal minds in the country, Matthew Stuart Miller. Matt's been named one of Bloomberg Law's 40 under 40 and has overseen transactions ranging from $100 million to over $1 billion, having successfully negotiated and closed over 100 deals for some of the largest public and private companies in the world. Matt will have a wealth of knowledge from startup to exit strategies. Matt, welcome to the show.
Hey, Rodman. Thanks so much for having me.
So excited to have you here today. You know, we've got a lot of entrepreneurs that watch this show and listen to this show, and a lot of them have a lot of different businesses, or they're starting a business, or they're deep into their business, and they're looking for really solid fundamentals that they can execute on. When people are first starting out, it can be very overwhelming, particularly when you're talking about all the regulation and the documentation and the legal work that you want to do. But where should people take a step back and really start to focus their beginning efforts?
You're exactly right. I mean, it's a great question. I think what I like about founders so much is that they're fearless, right? They are willing to charge hard. They're willing to put their ideas out there, put themselves out there, and they trust themselves. But unfortunately, the legal process is not just something you can manufacture. It exists outside of you, independent of you, whether you like it or not. And so I have something I've developed for founders, that these fearless founders, as I like to call them. And it's actually a framework built around the acronym No Fears. So no fears. So N is name, right? O is organization type and structure. So like LLC, S Corporation, C Corp. File is, file that your organizational document with the Secretary of State, right? EIN is EIN number. That's your social security number for your business. Okay. You need an EIN to get an account. That's the A. Then you need resolutions. That refers to governance and getting your board together and passing the right kind of resolutions to get your business off the ground on the right foot, legally speaking. And then last is stock, right? So issuing stock to your employees. I think that covers the basics of getting your business in a financial and legal place where you're ready to actually take the next step on firm legal footing. Not perfect, but at least you have all the boxes checked. The idea is that you can take anybody can form a company. It's just a matter of having to address certain unknowns about that process. And the thing about unknown, is we're afraid of what we don't know or we don't understand. But one of the things I like so much about being a lawyer is to help give people the knowledge that they can use to conquer their fears, go out into the world and create products and services that can help and change people's lives.
Right. And we're always talking about aligning purpose with what you're doing in life. And entrepreneurs are great at that. I mean, if you're entrepreneurial, it's typically because you're excited about something, but we also look at shiny objects. We also jump into things a little bit quicker than we should be. At times, we're not doing some of the analytics. We're not doing some of the risk mitigation before we're jumping into it. So I think it's always important to take that step back, really think about who you are, what you want to be doing, but also making sure that you're setting yourself up properly when it comes to all these formalities that you have to go through, whether it be doing your incorporation papers and then selecting your structure, or trying to think through, how am I going to be structured? What's that going to look like? There are so many things that as an entrepreneur, you just don't think about up front because you're so excited about what you want to be doing. And you got to be starting with the end in mind when you're starting a company.
That's right. There are three things that every founder should have. And number one is a good CPA. Number two is a good attorney. And number three is a great co-founder. If you have those three things in place, you can pretty much weather any storm that's going to come your way, and you can take time to adapt. Of course, the big limitation for most startups and most entrepreneurs is capital, right? And so that's, not really always in our control. But if you have those three things in place, you can be in a good position to succeed.
Well, and when you talk about CPA, get a good lawyer, and then get a good founder or a good business partner, I would argue that out of those three, the hardest thing to do is to get the best business partner, because
Right. Yeah.
try to sort through that and make sure that you've got somebody that's aligned with you, and they don't have to think exactly like you. But I mean, for me, I've been blessed with some really good business partners. Early on, though, I had a few that might not have served what we were doing so well. And, for me, it's a matter of, can I get in a room with somebody and in 20 minutes really make solid decisions and be moving forward on really fundamentally strong ideas, or pivoting to something that works better than maybe what hasn't been working. So I think getting a really good business partner is critical. The hardest of the three, not less important than the other two, but very difficult.
Well, it is difficult, and it probably is more important if I had to argue. I think you can replace your CPA, you can find a new lawyer. Hopefully none of my current clients get rid of me, but you can find a new lawyer, you can replace a lawyer, but it's really hard to replace a business partner. There's a lot of issues that come around having a relationship that doesn't work out, and they can go wrong for a lot of reasons, right? No one gets into business with somebody thinking, oh, this is probably going to not work out. Everyone has aspirations, dreams about how this is going to be a wild success. But in the legal world, in the real world, you need to plan for a downside scenario. And so one of the first things that I always advise my clients to do is work with their business partner to come up with some sort of arrangement, a contract or an agreement that sets out the rights and their obligations in respect of the business, right? So this can look in various ways depending on, for example, if you're a corporation, you might be talking about a shareholder agreement, right? This is an agreement between you and your business partners in terms of how you're going to vote, how you're going to govern the business, right? What's going to happen if there's a disagreement? And similarly, if you're an LLC, that can look like an operating agreement where it talks, I'm sure you've seen plenty of operating agreements, or the concept where the operating agreement itself will talk about, okay, what are the rights of the members, right? What are the rights of the managers in the business, all right? If you are a member, but you don't own a majority, do you have certain voting rights that give you the right to object or to require a vote of a larger number of shareholders over things that may not be in your best interest? And of course, board seats, and the list goes on. But having those critical contractual relationships in place is important, because not only does it allow the parties to understand how they relate to one another legally, but oftentimes it can preserve the relationship with your most trusted partner, right? Because a lot of disputes happen, a lot of disagreements happen, not because of any ill will or because of, they just don't want this business to work out, but they happen because of lack of clarity and lack of organization.
That is such great advice. And I think about my entrepreneurial journey myself. And early on, I was the biggest offender. I was the guy who's like, oh, let's just go. You can trust me, I can trust you. And it's not really even a matter of trust as much. It's a matter of protecting one another to make sure that you're giving your partner a very clear and concise picture of what those expectations are, and he's got the same of you. I mean, it's almost something that you need to provide to your business partner as just as a courtesy, and to make sure that you're going to be moving forward on the same page. And if you get that dispute, like you were talking about, if you run into something where you're anxious about something or don't understand why something's done a certain way, you can just go back to those documents and you can go, listen, here's what it says in our operating agreement. Here's what it says we're going to do in these instances. So I couldn't agree with you more. Early in my career, I was horrible at that. Now I demand it every single time.
It sounds self-serving to say, but a lot of people don't take the time to document properly because they're busy and time is precious and they have deadlines, right? But the other reason is that it's expensive, right? The cost to properly document a business relationship is costly. There's a lot of technologies coming out right now that allow you to do that more efficiently. This is not going to be a plug for using AI to draft your contracts. I can't endorse that, at least not yet. We're still in the very, very first quarter of this tech revolution that we're going through right now. But there's also LegalZoom is out there, right? Which is a relatively low cost way of papering a deal. The thing you got to watch out with very low cost services, and nothing against LegalZoom and nothing against other firms or providers that will provide these types of agreements for a very low fee. But what you tend to get into is a lack of customization, right? And we talk about in business, well, what's your uniqueness? What's your unique proposition? Like what distinguishing characteristic are you offering to the world? And so there's an inherent inconsistency by how we talk about being such a distinguished brand, such a distinguished business, but yet we'll take a form contract off the shelf that isn't tailored to our situation at all and try to make that work, right? And some great companies fall apart because of that, right? And then the time restrictions around just documenting things appropriately, it's worth it to take the time. It's worth it to sign every contract. I know it's difficult, but if you have an assistant, if you have some way to track, the parties down to get the signatures and just to dot the I's and cross the T's to the best of your ability, if you can do that, you will save yourself money down the road. It may not seem like it. You may feel like that's expensive to have a lawyer go through that process for you or have, someone else do it for you that you're paying. But I can personally say over 15 years of working on various companies that I have seen not just tens of thousands, but I've seen hundreds of thousands of dollars spent needlessly on disputes and waste because people were hasty in how they were entering into their contracts. So haste does create waste in the legal world, and it's really important to take the time to do things the right way, as hard as that is, right? And that really comes down, I think, to the discipline of the founder and the founding team to say, look, I know one of our strengths is running through walls and getting things done and doing the impossible, but sometimes we need to carve out a little bit of time to make sure that we're going back over everything and making sure we dot our I's and cross our T's, and we're holding ourselves accountable to do that.
So it's either going to cost you a little bit now or potentially an awful lot later. I mean, I know that so many people, and I see these disputes happen. And a lot of times, you've got two parties that get upset about something, and then you've got a dispute, and then you end up in court, and then nobody wins when you get into that situation. So I always tell people, get it right early. Make sure that you've got everything in place early. All my business partners that I have right now, we've all got solid agreements. Not because I don't trust them, not because I don't have a love for them, but because I just want to make sure that we're on the same page and that we're moving toward the same place. And that if a dispute does come up, we can settle it. We can get it figured out without having to go to that next step, without having to go to legal action. So I think that, what you do in the beginning is just as critical as what you're doing in your business along the journey when you get to those next steps.
Yeah, absolutely. And I'd say there's two things you can do right now that would be very important for your business, depending on how you're structured. The first thing, a lot of partnerships start off where you have two founders, right? And we just talked about how having a co-founder is one of the most important decisions you ever make, and sometimes the most expensive decision you ever make. But a lot of partnerships where you have a 50-50 ownership don't contain something called a buy-sell clause, right? And a buy-sell provision is very important because that's what helps you get past the impasse or the deadlock when you have two parties that can't agree on something. Now, look, invariably it happens. They're rarely triggered, but in a downside scenario where the parties just can't resolve their differences, it's really important to have a buy-sell clause, and that buy-sell clause should stipulate clearly the process to value the underlying equity interest. It's not enough just to say, okay, if we have a disagreement, you'll buy me out and then you can do whatever you want, right? It seems to kind of move the ball forward in terms of the disagreement or the deadlock. But the next question behind that is, well, how much do I need to pay you in order to buy you out, right? And that's typically where parties will go to litigation, right? That's where parties will typically fight over the amount that they are owed or the cost of it, right? Which the economic piece. You can resolve it short of litigation by having some sort of provision where you appoint an independent advisor or an independent accounting firm to come in and value your business. That way they can help you determine what the price of that underlying equity is so that you can actually complete the buy-sell process. Because without putting a price tag on those units, the buy-sell clause is worthless. I've seen a lot of agreements where the parties try to get away from that by having some sort of situation where the first person that makes the offer is at risk of, if they make too low of an offer, the recipient of the offer can make a counteroffer at the same price. And so that's meant to encourage, it's kind of based on the prisoner's dilemma, where you want to encourage the first party to make a high enough offer so that they're disincentivized from underbidding, right? But there's no real economic value there, and we highly recommend you have a third party advisor go and look at your business. Although there's an expense to that, it's very quick, it's very easy. The second thing that I think is very important for people to have in their contracts generally with customers, suppliers, to the extent you can get it, is an arbitration clause. Okay, so arbitration is an alternate dispute forum. There's different providers, JAMS, the American Arbitration Association. But what's key about arbitration is that it's private, it's confidential, and it just takes off the table what happens. I'm going through something right now where a partnership is in dispute. We're working with one of the parties, and the other party is threatening litigation, not because they have the best claims necessarily or because their fact pattern is that persuasive, but they know that if they can launch a public litigation, that will put pressure on the other party to see their side of the story. And you just want to take that off the table. So I think a buy-sell clause that has some rational economic calculation built into it, as well as an alternate dispute resolution that puts things, like mandatorily puts things into an arbitration forum that's confidential, is a great way to ease disputes later down the road and hopefully preserve a partnership that should stay together.
And so, Matt, in an instance like that, the example that you gave, those guys didn't have an arbitration clause in their agreement?
That's right. Yeah, they had an agreement. They had a buy-sell provision. They had a lot of voting provisions, everything you would think to have. They had a lawyer prepare the documents for them, but they didn't have this arbitration clause. And I think if they had that, they would be much more willing to come to the table and work out things together. And there's just too many, once the litigators get involved, I can say that because I'm not a litigator, but have lots of friends that are litigators. Once they get involved, their talent and their goal and their duty to their client is to use every tool at their disposal to achieve their client's objectives. One of those tools, fortunately or unfortunately, is public scrutiny and the fact that when you file a lawsuit, it's public information. I don't think a lot of people realize that, but if you sue someone in public court, state or federal court, anybody, anywhere in the world can go and request those documents, and they can read about the complaints. They can read about the allegations. They don't have to be true. I think there's an ethical standard for lawyers to file pleadings that they know are not true. You're not allowed to do that. But there's pretty broad parameters around making allegations towards another party. And, you just want to protect yourself against that. And by the way, that's not just for parties in a partnership agreement, but it's also with, other business parties, customers, suppliers, things of that nature. If you are in a public facing business, which frankly we all are, you would like to direct any kind of dispute like that to a private forum. And the way you do that is through an arbitration agreement.
Hey, Matt, when you're talking about business, starting a business, very few people start to think about building something of value. They just want to be in business. They want to make money. They want to cover their monthly bills, those types of things, doing something they love, of course. But a lot of people aren't thinking about how do I build value in the company that I'm creating and that I'm building. What kind of suggestions would you give to them? And I know this ranges. You've got somebody who, for an example, I came from the valuation industry, and a lot of people would go to the valuation, they'd be a solopreneur. They would put their shingle out. They would start to do valuations on, say, commercial real estate, but then they would get to the end of the career and they wouldn't have much to show for it. It's almost like they're going to keep working until that shingle falls off of their place of business. So, but then you've got these other folks too, who might build a business that I could step out of tomorrow and somebody else could step in and it could continue on into perpetuity. What kind of ideas or thoughts would you give people who are like, I want to build something that creates value. So when I get to this end of this journey, so when I get to the end of the road, I do have something of value that I can sell and that I can profit from?
That's such a great question. Oh man, that is the question, really, right? Because I think there is a category of entrepreneur that goes out into business just to put something great into the world and has really no thought about how they're going to monetize it or exit at the end of the day. But what a lot of what I think about on a day-to-day basis as an M&A attorney is how do I help my clients exit successfully, right? And when you talk about begin with the end in mind, another way of saying that is know your exit strategy before you get into the process of actually even creating your product or service. Think about that from the beginning. Now, the truth is there are a lot of businesses that are more saleable than others. Okay, there are certain businesses that will drive a higher multiple on their revenue than others, right? I would say the types of businesses that drive a greater amount of a purchase price are the types of businesses that are more IP centric, right? That revolve around a body of intellectual property that you have exclusive use of or license to that no one else in the world has or can replicate without your permission, right? So those businesses are inherently more valuable. They're also inherently less dependent on their founder. Okay. So what you have a lot of times are people that create services businesses, which are extremely interesting and can be very profitable, but they're not the easiest business to exit in terms of getting out to the end when you want to retire and you want to move on with your life and do something else. It's harder to transition those businesses to a buyer, right? Because without you there running the shop day to day, they're just frankly not as valuable. And, I think there's ways that you can adjust for that. There's ways you can bring in people to help you scale. You can bring in associates, train them to, basically replace you, and the business goes on. And there's some continuity around that. There's some stewardship of your business around that that's helpful in terms of you making your business saleable. But there's nothing that's going to increase your value and your multiple, like having a body of IP that you have exclusive rights to use and to sell and license. But yeah, businesses that have a solid body of IP tend to be more valuable. Also, businesses that have recurring revenue tend to drive the highest valuations in terms of the multiples that a third-party buyer are willing to pay for a business. If you can combine a core body of IP with recurring revenue, and you've got a great business. If you can combine IP with recurring revenue with high margins, you've got a software company, right? And that's why we look at these businesses that are valued at, they have 80% margins, and then they're unicorn valuations, and some of them are even pre-revenue and they're unicorn valuations. And that's all based on, they have that magic 3 formula. Now, those are rare, right? And I don't think anyone should necessarily aspire to create that, because I think everyone needs to think to themselves, what is my uniqueness? What is the product or service do I want to put out in the world? What do I have that can solve people's problems and affect the kind of change or do the kind of good I want to see? That's what should drive us, not can I fit a model? That said, a lot of people find themselves starting a business the right way, and they get to year 5 or year 10, and they realize they've created a lifestyle business, which is a business that is really meant and designed and caters to the life of the founders to support them. But once they leave the business, that's it. And there's not a lot of value that continues on after them. And the question really becomes, what do you do if you're in a lifestyle business? If you find yourself in the type of business that is really dependent on your ability to provide services for the client. And this can look at a lot of different ways. And I don't know if I want to name certain types of lifestyle businesses, but I think, because I think some might look like a lifestyle business, but the truth is they could be valuable. For example, physician practices. Those are service businesses that look like, hey, once the doctor stops providing services, that's it, right? But those are very valuable because they're specialized, because of their geographic nexus and the way they can build a brand and a reputation locally, right? But even those businesses, if you're a gastroenterologist or a dermatologist, or take your pick of specialty, even those businesses will be required to stay on for at least 5 years after they sell by the buyer, right? So there's a recognition that those businesses are inherently dependent on their founder. I was actually talking to a founder recently who was in this exact situation. We were talking about her next steps, and she was, looking to get out of the business, and she was looking to go on to something else. And she was really hoping that the business she had created would be a platform and a springboard for her next phase in life. And that was really dependent on driving a good sales price. Well, the truth is where she was at that moment was not going to get her to where she wanted to go. It wasn't going to be the kind of exit that would really fund the next phase of her life. So we started talking about some strategies. We said, you don't have to just sell to a third-party buyer. You don't have to sell to a private equity firm or say another company that does what you do. And it doesn't have to look like a typical M&A transaction. There's lots of ways to exit your business that don't involve selling your assets or selling your stock. For example, joint ventures are extremely popular and extremely effective at not only eventually exiting your business, but if you don't have a great body of IP, if you're not there yet, sometimes finding another partner, another business that you can combine with, maybe they have strengths that you need, maybe you have strengths that they need, but between the both of you, you can create a new third category of intellectual property that can be more valuable than probably the both of you put together. Right now, all of a sudden, you own, say, call it 50%, just to use even numbers. You and your JV partner now own 50% of this new joint venture, right? But if that becomes wildly profitable, your JV partner may buy you out in 5 years, right? At a higher multiple than you would have had you sold 5 years earlier to a direct buyer. So now there's different ways of thinking about this to build that body of IP to, get to a recurring revenue model. So another way is like change your revenue model a little bit. Take a coach, or you have a certification course, right? Those are, or even a restaurant, right? We know about restaurants in the franchise space, right? Those restaurants or certification courses are very franchisable. And all of a sudden you go from providing a service that's based on your IP to all of a sudden licensing that IP. And you're no longer a service provider in that. In the eyes of a private equity buyer, you're no longer a service business. You're a licensor, right? Licensors are more valuable. So if you can pivot to a franchise model, potentially that could be a way to change your revenue stream from a subscription to more of a recurring revenue model, that franchisee payments, for example. And there's lots of different ways that you can scale and create marketing budgets and things like that that can drive higher value on the franchise side. And so I've seen that a lot in those types of lifestyle businesses that you want to take to the next level. And by the way, franchises, are one of the most valuable areas for private equity to invest in. And I've seen a lot, whether it's fitness, gyms, spas, coaching certification courses. There's a lot of opportunity in that area.
Sometimes we can aimlessly drift through our life, not really sure how to break the patterns and live the life that you've always dreamed of. I get it. I have been there, so caught up in chasing opportunities until I found myself in a life that felt foreign to me. It took me years to unwind the messy web to get back to what I've been put on this planet to do. And let me tell you this, purpose doesn't have to feel out of arm's reach. And I've designed a plan for you to do a little bit each day over the next 30 days in a challenge that I call the Outlier 30. It's specifically designed to help you find or create more clarity around your purpose. So if you're feeling lost and you want to finally turn things around and live that life that you were destined to create, sign up right now. It's free. You have absolutely nothing to lose and the whole world to gain. Visit gorodman.com/outlier30 today.
So did that answer your question?
No, for sure it did. I do want to pivot a little bit, and I want to talk a little bit about multiples. We touched on multiples a little bit, and I've been through enough acquisitions. I've had over 25 companies in my lifetime. I mean, all of them have been acquired at this point, with the exception of a couple that have been near and dear to me. But in terms of multiples, I know that multiples can range. And I think it'd be valuable for people to hear about what kind of things you can do that can have an impact on your multiple. Because, we were talking about, you talked about physicians. For example, I think about a lot of my friends in the chiropractic business who they go in and it's up to them. If they can't go in on a certain day and crack a back, they're probably not going to get paid. So, I've got gentlemen like that or ladies like that who will avoid, say, going snowboarding because they can't risk breaking that wrist or maybe hurting their leg, those kind of things. But overall, just general about multiples. A lot of the stuff that I've had has been pretty service oriented. So it hasn't been at the absolute lowest end of the spectrum when it comes to the multiples. But if people are thinking about types of businesses or types of situations that they can set up for themselves to have better multiples when they get to that exit, what kind of things should they be looking at?
Yeah, I wish I had a great way of describing what I do, like crack a back or something that rhymes. The closest I get is to mergers and acquisitions is murders and acquisitions. And so sometimes I can slip that in and people don't even hear it. So multiples are a curious thing because they don't stay fixed, right? There's things you can do to your business that can, like you were suggesting, drive a higher multiple, like we were talking about earlier. But you may be in a market environment, or you may be in a geographic location where no matter what you do, it's just the market has changed, right? And that dictates the multiple. But my number one advice in terms of businesses that are seeking to optimize the multiple is to go out and find a reputable, strong, trustworthy, value-add investment banker to help you with that process. A lot of people hear investment banker and they think Wall Street, they think, they're not sure what they actually do. But an investment banker is to your business what a real estate agent is to a house. Okay, they will take your business, they will understand your financials, they'll understand your revenue, they'll understand, how you're distinguished in the market, and they will stage your house, they'll stage your business, and they will shop your business to find the best buyer who needs your business. And that's really the key to getting a good multiple, is finding the right buyer, right? The right partner. In the same way that to get your business off the ground and to achieve that scale and to really get the best product out into the world, to achieve the best exit at the best price, to optimize those characteristics, the partner that you need is an investment banker. A lot of people will run a process and they say, oh, we don't need an investment banker. And they try to do it themselves, and they're leaving a lot of on the table, potentially in terms of cash. And I say that even having clients that have done their own process before, who did just fine, and you do come up on occasions where someone just makes you a great offer for your business, and it's like, this is so good that you would never turn it down. And I've also had people in that situation before, and I say, well, this is great. Let's close as soon as possible, because if they realize how much money they're paying you, they might change their mind. So let's close this deal now. There's always those situations, but generally you want to get an investment banker to guide you through the process, to really run a process, because it is I keep using that word, process. It is a journey to go from, okay, you're ready to sell your business. Let's get organized. There's a whole diligence you're going to need to be involved in that will involve financial and legal aspects to it. And then you'll have to, do you want to do a bid auction? Do you want to, do you want to just reach out discreetly to potential buyers, right? Are you looking at a private equity? Are you looking at more of a strategic? There's things that an investment banker can help you with that's their business. And so that would be my number one advice in terms of achieving a multiple. But beyond that, there are resources that are out there. People do a lot in terms of reporting data on recent transactions. And from that, they can infer and they can compile current lists of multiples that are in the marketplace for your business. I think GF data is one that we've used from time to time, that is very good at drilling down into the very specific industry category. So if you're really saying, well, I'm a type of business that's really in this discrete niche, like what would a multiple be in my area? You might want to find a resource like that to go and do some research on your own.
Well, and people should understand too, there's no one multiple. There's not like, I've got this business, what's my multiple? Because there's so many different things that come into play. Like I know in a lot of my acquisitions where my companies were bought, it was, what's the team? How long have they been there? Are they going to stay? Are they going to go? What does the cash flow look like? Are they on the upswing? Are they on the downswing? There's just so many different things that can impact that multiple, that people just need to be aware that, if I've got this type of business, it might be, let's say they say, well, I've got this business, it's a 4 multiple. Well, no, not necessarily. There are so many other things. Our company, had a range. They said, well, we're looking at a 3 to 5 range, kind of depending on what you guys bring to the table. Is leadership going to stay? Is leadership going to go? We had technology involved. So we had our own proprietary tech platform built into it. That pushed our multiple up. So there's no one size fit all when it comes to multiples, but a lot of people think that there are.
Yeah, it's a range, and it's really the beauty is in the eye of the beholder, and certain buyers will value your business more than others. It's partly objective, but it's partly subjective.
Yes. So what would you tell people though? Let's go back to this beginner entrepreneur. Like we said, we've got a lot of people who listen to this podcast, some just coming in, some of them, they might be seasoned entrepreneurs. Everybody's at a different place in their journey. But let's talk about that new guy, that person who's coming in, trying to dissect it. My wife's a really good example of this. When she started her flower farm here, it was just simply, I plant a seed, I water the seed, we grow a flower, we sell the flower, right? And as a business, that's a really tough business. But then she started adding in classes on how to grow flowers, workshops on how to do wreaths. She's doing her own product line. She's doing soap. She's doing just about everything, right? So all of a sudden, she's adding, and I guess you'd call that her IPs. She's adding these pieces in that add value to her company. But what about that guy starting out? He's got to be overwhelmed, thinking through the whole thing, going, well, I want to build something valuable. So when I get to be the time in my life where I don't want to be doing this anymore, I'm set up properly and I've got a good exit strategy. What should they be thinking right out of the gates?
That's a great question. I mean, some of that touches on commercial considerations and some of it touches on legal. For the commercial part, I would say, get that good, strategist, that good coach, that good business partner that can help you think through how to best scale your business and how to, create product, like to use your example, how do we do this in a way that's going to be, maximizing the people, our reach, the who we serve, and how do we build efficiencies and things like that. And I do agree that that's a lot of that's IP, and that's something that is very valuable. When we talk about IP and we talk about building value from a legal perspective, there are things you can do in the beginning that will help you later down the road. And one of those things is inevitably when you start to scale, but even from the founder stage, when you are just you and maybe your partner are building the business, having certain contracts in place that retain and capture that IP in the business are critical. The one agreement I'm thinking about right now is an invention assignment clause. Okay. You've probably heard of this. You've probably seen it before. But what an invention assignment clause does is it says, if you're creating intellectual property or you're creating proprietary information or you're preparing anything within the scope of your employment or your services to the company, you're agreeing to assign that intellectual property back to the business. Okay. That is a very critical document that a lot of early stage companies miss, precisely for the same reasons that a lot of them don't document things, but because of the cost and because of complexity and all that. And so it's totally understandable, but it's almost inexcusable if you're in an IP heavy business not to have the founders and their employees assigning that IP back to the company. Because here's what happens if you don't have an invention assignment agreement in your employment agreements or your service contracts, is that who is ever involved in creating that IP under law becomes a co-owner with you in that IP. And so later when you go to sell your business, you think it's just you and your stockholders that are going to be the sellers of this company. But all of a sudden you find out that in diligence, someone else owns that IP and now has a claim, now has a stake to some of that value that you're selling. They're not an equity holder, but they have leverage now because your business is built on someone else's property. So you want to be very careful that you get those documents in place. So just to kind of reiterate, then we talked about having a partnership or an operating agreement, stockholders agreement, and we talked about having an invention assignment clause, right, with your employees. I think those are the types of vertical and horizontal contracts in the beginning stages that can really help your business.
Yeah, and it's funny because I started seeing these. I didn't know what they were for a long time as an entrepreneur. They weren't put in front of me. But then when I started selling the companies, a lot of them would come and have me sign that document saying, hey, listen, moving forward, we want you to stay on, that anything you're doing under this, and this tag is part of our IP, is part of our property. You don't have ownership rights to it. And it opened my eyes to that, because you would think that if I hired somebody and they did work for me, it's mine. But that's not the case. Is that what it is?
it's not the case in every case. There are certain situations, I think, if you're an employee, that the work for hire provisions that are, I believe, in Title 17 of the U.S. Code. Don't quote me on that. I'm not an IP lawyer. We do have specialists that will handle those issues, but it's not automatic. At least the assignment itself is not automatic. And here's another thing. A lot of times the invention assignment clause itself can be defective if it doesn't have a current assignment language built into it. So, for example, the sentence, such and such employee will assign its IP to the company, that's actually a defective assignment clause, because what does will assign mean? Now, today, next year, right? So an effective assignment clause that, I think everyone's going to go back and look at their invention assignment agreements right now, but it should say such and such employee will and does hereby assign their IP to the company, right? That hereby language is an effective assignment today when they assign this agreement. Otherwise, you have to fill it in with, like you said, like just a pre-closing conformatory assignment, which we do in any case. We try to lock up the IP in so many different ways if it's that type of company. But no, it's a great observation. For sure. It's not automatic. You got to think about the actual language.
Hey, Matt, what would you say is the biggest mistake new entrepreneurs make in the beginning?
There's so many. So I would say the biggie, other than, the IP that we talked about, a business that gets to the point where it's valuable enough to sell has typically been around for a long time. And it has gone through a number of employees, a number of contracts, a number of customers, probably changed suppliers 2 or 3 times. And it along the way develops habits, ways of operating, which really aren't tied to any kind of best practice. And they are built on just how the company's always done things. And that can exist, by the way, at a solopreneur, all the way up to Fortune 500 to a public company. Okay, believe it or not. Like, we've seen subsidiaries of public companies that operate a lot like, just not the type of discipline, not the type of rigor you'd expect to see. I mean, we diligence these companies and thought to ourselves, man, we have to sort of note the fact that we don't think management is paying that close of attention, right? Like it's crazy. You think you're saying something like that for an international company, but you see that sometimes. And so at any level across the board, I think having discipline as a founder is crucial. I think we talked about that earlier, slowing down, doing things the right way. You don't want to get into a habit of just doing things the way that you do them because it's easiest for you in the moment, and then find out later that you haven't complied with certain laws, that you haven't protected your IP, that you haven't signed contracts. And I'll talk one more in a second. I'll talk about one important contract that often isn't signed that can be a big issue later down the road. But it's having that discipline, having that rigor to do things the right way to avoid pitfalls down the road is an important attribute to instill in the founding team. I think I see this most commonly, surprisingly, in the capitalization table. So if you're a business that takes equity investment, for example, in order to scale your products and services, your capitalization table is something that you probably are familiar with. You probably spend a lot of time on. You might think you have a great capitalization table. There's lots of different ways to prepare a cap table, but at its essence, a cap table is simply a list of the owners of a business, what they've contributed to the business, and how much equity they own. Okay. And you would be surprised how often either the cap table is not correct, or it hasn't been updated, or it exists, like it has all the right numbers and it has all the right, ownership information and how much equity they own. But when you go and you say, okay, now provide me the purchase agreements for that equity that is on the cap table, they can't do it. Right. And that's not going to work in terms of verifying the ownership, because if you own a share of stock, it's property, right? You're supposed to have title to that stock. And in order to have title, legally speaking, you need to have some sort of documentation showing that you own it. Right. So a lot of times you'll see people send out the purchase agreements, send out the subscription docs. They'll send out the board consents in order to approve everything, but they actually won't sign them ever, right? And they won't actually contribute the cash. I mean, it's not that big of an issue, but just to kind of illustrate the point, we often issue founder stock to startup companies, okay? And the founder stock can be almost nominally valued, call it half a penny a share. But if you issue 1 million shares at half a penny, do the math, there needs to be, and I can't do the math right now, but there needs to be a check written to the company for those shares, right? So like that seems completely insignificant, but legally speaking, if you haven't paid for the equity that you say you own, you don't own it. The reason that matters is when it comes down to actually approving the transaction, and say you need a majority of the voting shares in order to approve a transaction, and you're so excited because you just approved it by 51%, and you can go sell your business now, but then you realize that 1% that you needed to have a majority actually never signed their subscription agreement, and they don't legally own the shares. That's a critical issue, that all of a sudden now you've empowered all the minority shareholders that don't want to sell. Now they are able to weigh in and really challenge your process.
So Matt, obviously, if you're an entrepreneur, this can all be very overwhelming. I mean, there's a lot of information. There's a lot to do. People that think they can just go throw a shingle up and be in business, they're not thinking far enough out. They're not going deep enough, because there's so much that goes along to make sure that you're doing things the right way. But I want people to make sure that they can find you to get this information, or if they want to ask you questions or just connect with you. Where do you want people to go to find you?
I'm a partner at a law firm called K&L Gates. So you can go on to the internet and type in K&L Gates and search by people, and you'll find me eventually. I'm also on LinkedIn at Matthew Stuart Miller at LinkedIn.
So Matt, I always ask this question on the show. What I want to know is, if you could go back in time and give your younger self one piece of advice, what would be the most valuable piece of advice that you would give to yourself?
That's a great question. I would say the most valuable piece of information I would give to myself is just keep the faith. Don't give up. It's going to be okay. I would just say that to myself over and over again. And I think we've all gone through ups and downs, and we've had high highs and low lows. And I think the truth is that you could just be 100 yards away from your goal and not realize it. So you just got to keep going. You got to keep fighting. You got to keep trying. You got to keep learning, iterating, and just never give up. And so I think that's something that I would tell myself, is just never give up. Keep the faith.
Amen. That is great advice. Matt, thank you so much for coming on the show today.
Thank you so much, Rodman.